All right, everybody. Let's go ahead and get started. Thank you so much for joining us this afternoon. My name is Tony Julianelle, and I serve on the leadership team at Atlas Real Estate, and joined here by Ryan Boykin, one of the co-founders of Atlas. Our goal today is to give just a quick commentary. Ryan will share a few thoughts, and then we're just going to open this up for Q&A. And the way that that's going to work is at the bottom of your screen in the Zoom meeting is a button for Q&A. And you'll be able to click on that and type a question in that I will then ask, and then we'll go through the Q&A that way. So we'll do some opening, as I said, some opening comments, and you're welcome now to, as we do those opening comments, to start asking questions through the typed in Q&A. If you have any questions about how to do that, there's also a chat feature where you're able to chat directly with me, and you're welcome to use that feature as well. But hopefully most of our questions will come through the Q&A and not the chat. So with that, I get to introduce my good friend, Ryan Boykin, co-founder of Atlas Real Estate, owner of multiple real estate classes, and one of the deep thinkers in our space when it comes to investment real estate. So Ryan, take it away.
Thanks, Tony. One quick comment. If anybody can't hear me or it's chattery, staccato, go ahead and throw that in the chat. We'll see that and we'll see if we can repair it. I think that our internet connection is quite strong. It's hardwired in, but hoping it's okay. So briefly, for those of you that don't know Atlas, I'll just say that Atlas is comprised of 4 distinct business streams. The first of which is we're a property management company. We manage approximately 3,200 units of residential real estate in Colorado and Phoenix. The second category is our Atlas brokerage, which is focused on investment real estate and helping individuals to purchase investment real estate, mostly for the purpose of saving for long term, as well as helping homeowners and home buyers and sellers to complete that transaction, usually in their first, second, and third home transaction, not so much in the high-end transaction category. The third thing that we do is we are a partner broker with Zillow Offers in their program to purchase homes through Zillow. And we transact quite a few homes and purchase and sale for them when they buy and sell homes. And then the fourth one is we have an institutional side to our business wherein we help large private equity companies to purchase their own portfolios of single family for rent real estate. Currently, we do that in Colorado, Arizona, and Nevada. And we probably help them to purchase maybe 100, 150 homes a month in that category. So some good breadth in terms of what we do today. I also want to just comment on who we are as a company fundamentally and how we make decisions. The first thing that I'd say is that the decisions that we make in our company are almost in every situation driven from the idea that we can survive the long term and that we will accept short-term pain in exchange for long-term gain. And we try to be a very long-term oriented organization. The second thing that really is our guiding principle is we try to make sure that everything that we do falls within our core value of good for you, good for me, and good for everything. And I think we're going to have a wonderful opportunity right now to be tested on whether or not we can really follow through on that. I believe that we can. I'm certain that we can under the current environment. So that's just a little bit about Atlas in case you didn't know that about us. And I think that you'll see some of that commentary bleed through in my answers on the Q&A here. I do want to comment a little bit on our history for those that don't know as well, and then maybe we can kind of open it up to question and answer. We were founded as a real estate investing group in 2008. Jason Shepard and myself began to purchase real estate in 2008 at the beginning of the foreclosure epidemic and collapse. I think over the past 10 or so years, we've probably transacted on several thousand assets that we've purchased for our own investment account for ourselves. And of course, if you add in all the other investors, quite a bit more than that. And we've been through the moments of 2008 to 2011 that were incredibly difficult. I remember very distinctly the moments when I owned assets and rents were compressing, and what that meant to property manage those assets in those environments. In our first year and a half in business, we were a fix and flip company. We did probably 400 or 500 fix and flips in that first year and a half. Then we transitioned to be a long-term oriented company, and our portfolio of real estate is made up of single family, multifamily, industrial, office, retail, restaurant, all sorts of mixed use, urban infill. We don't have any hotel, we don't have any public storage, but pretty much every other category of real estate we do have exposure in. And all of it we own for the long term, with the idea that we should own those assets for a 20-year period. And that if we do it right, we'll have a great savings account that we can make great decisions from. So let's see here. That's a little bit about our history. The final comment that I make is that we're trying to be a voice, almost a thought leader as it relates to real estate and the areas that we touch within real estate. That is not to say that we have answers as to what's going on with the market right now. It's not to say that we know what's going to happen even in the short term, certainly not in the medium and long term. But I've gotten so many questions over the last week or so that are all very similar in terms of how we approach the current environment. And so this is an opportunity, or sort of an exercise for us to be collaborative with you, to voice our opinion, to hear from you, and then hopefully we do this again. And so we don't have the answers. We're just trying to be good in getting the dialogue going so that we can all be best prepared. So I'll pause there. I have a couple other comments that I can make, and I don't know if we have questions coming in on the line or not. If not, then I'm going to talk about the market environment and what it kind of means to us right now. Tony, any thoughts, or should I keep going?
Yeah, so just encourage everyone to start asking their questions in the Q&A section. We do have a few questions, Ryan, but I'd like a few more to come in. So why don't you continue the commentary, and again, encourage everyone to start typing in your questions in the Q&A, and we'll start getting them answered here in a moment.
Great. So I think that where I'd start is just to set the table in terms of what the market environment in front of us looks like. And I'd like to really emphasize in front of us all of the tools that we have had in the past to look in the rearview mirror for what the value of a property is, for the rents of that asset, for the days on market and how competitive it is, and even the debt environment are not going to be tools that are going to be helpful in us understanding what the market ahead of us is in the immediate future. They may become helpful again, and we may be able to have reliability associated with the rearview mirror. But in this moment right now, I can't rely on that. And so that's my starting point, is that, of course, this is a moment of uncertainty, and the data that we rely on isn't going to be very helpful. And so therefore, I backpedal a little bit and I say, how do I even determine what the value of real estate is? How do I determine what the rent should be on an asset that I own? Historically, Atlas, over the last several years, I think 4, 5, 6 years, we've always been pretty close in our entire portfolio of property management to managing our properties at about 97.5% occupied and collected. Now, whenever we talk about occupancy in our company, we don't talk about just physical occupancy. We talk about economic occupancy, which means that, of course, in that home or that apartment, the unit is occupied. It also means that the unit is being paid for. And other people look at it a little bit differently, but 97.5% occupied and collected is a tremendous number, certainly across the size portfolio that we have. I can't look at that as my measuring stick for the future of what our occupancy and collections will look like in any fashion. And I certainly can't look at how we're going to increase rents year over year and that kind of thing. I think that it's even difficult to know what expenses will look like, because we probably will come into an environment where expenses should go down. So if I used to think that my expenses would go up by 1 to 3% per year, I've had half dozen to a dozen phone calls this week from contractors that have said, hey man, I know I blew you off on that job, but I'm ready to work. And that means that they're ready to work, and pricing is going to come down on a lot of those expenses. So we don't know how to determine all these things. We can't look at the rear view mirror. How can we determine some of those really, really salient points? this is 101 on a lot of economics and 101 on a lot of real estate, but all real estate is a function of supply and demand. And so if we ask ourselves, how have supply and demand changed in the United States right now, but let's talk about Colorado and Arizona. Let's start with this. On the supply side, housing, which is primarily our product, has not fundamentally changed. We haven't seen a drastic spike or decrease in terms of the number of homes that are listed for sale or the number of homes that are listed for rent. And those take a little bit of time to settle in. So the supply side in that regard hasn't changed very much. On top of that, the supply side of the number of housing units that are available to be lived in or being built can't change as dynamically as this issue, this COVID pandemic is making the world change. So supply fundamentally hasn't changed through this, and I think it will change in the coming months, but it depends on how long this issue remains. On the other side of it, you have the demand side, and demand, where has that changed? We often look at demand in terms of how it's changed in terms of what is the positive net in migration versus the negative out migration of a city. And so Denver, as an example, in the last 12 months had about 100,000 people move to Denver in positive net in migration. That means you take all the people that had left versus all the people that came in, and we are still left with 100,000 more that are in our city. So that's a great source of new demand to all of real estate, whether it be real estate purchases or rental. So that's good. That's a good check. And they're not going to move tomorrow. So that's not going to change the demand from them moving in or out tomorrow. And the amount of babies that we're having isn't going to change tomorrow. But what is changing right now, it's unemployment. And not only is it unemployment, but it's also compression in wages and the very high likelihood that we're moving into an environment of short-term immediate unemployment and short-term immediate wage compression, which will have a massive impact on the demand side of real estate. And so I think that's tricky. I think that it makes me nervous as to what we have ahead of us in the coming 1 to I don't know how many months. And in my mind, it's still very uncertain if this is a short-term issue or what could be a very long-term issue. It does appear that economically, this is going to have a devastating economic screeching halt effect on our society and our economy. So that's supply and demand. That's real estate. Don't look at the rearview mirror. Look at the forward-looking mirror. And we can begin to get indications of the forward-looking perspective. One of those is our team tracks weekly at this point what it looks like in terms of new listings, new purchases, new sales, all that good stuff in terms of the market as a whole, as well as what's going on in the rental market. And so we're getting weekly data on that. And I think that in the next 2 weeks, we'll start to have an indication in terms of what the curve is changing to. Obviously, the supply and demand curve, that's an economic curve, not the curve as we hear in the news right now, which is a coronavirus curve. So all of this for me means that in the short term, I'm going to have a ton of uncertainty, and I'm going to have a lot of people that are not able to pay their rent, a lot of people that are not going to be able to pay their mortgages. And so the impact to me individually and the impact that we're trying to share to this broader community is that this is absolutely a time to be very careful with every dollar that you spend. This is a time to delay non-essential expenses on the personal level and certainly on the real estate level as well. Certainly delay wherever possible, and you have to think critically on this capital expenditure that you were going to make on the real estate level. And saving money is going to be huge because all of our revenue, all of our income is going to be compressed. And the separate side of this is a moment to have reserves. And we talk a lot about this with Atlas to our existing clients and our new clients is that, do you have reserves for that rainy day? Well, it's going to be more than a rainy day. And so what does it look like as you have reserves and how can you build those right now? And I'll come back to strategies on that based on questions that I hear. And I think that the final thing that I'd say if you own rental properties is occupancy is everything. Occupancy is everything. Protect against vacancy at all costs, even if it means that you're going to have to take a haircut on your rent, even if it means that you have to work with your tenants in unique ways. Occupancy with a paying tenant is everything. So I'll pause there again. I have quite a bit more thoughts and notes, and I'll talk about prior rebounds or lack thereof based on pandemics if we need to. But I'm going to pause and just see if there's anything out there.
So we got a bunch of questions, and I'm going to tackle a whole bunch of them with just one quick response. And Ryan, I'm going to give you one to just start thinking about how are you handling rent defaults on your assets? And as Ryan gets ready to answer that one, there's a lot of questions in the queue about being able to make mortgage payments on investment properties when your renters are unable to pay their rent. We're going to issue some guidance on this. There's a lot happening through the FHFA, the Federal Housing Finance Authority, the governing body of Fannie Mae and Freddie Mac, around payment relief and forbearance. And so rather than spend a lot of our time on that today, we are going to send out a summary of what we know, as well as what we're hearing from some of the major lending servicers. So if you have a Fannie Mae or Freddie Mac, what's typically called a conventional mortgage, there is broad forbearance opportunity there around payments. If you have a commercial loan through another lender like a First Bank, then it will be a different process, but we anticipate a great deal of flexibility there as well. So lots of questions coming in on that topic. And I'm just going to say we're going to send out more information, and your property manager is going to be fully aware of what those options are and able to talk through them with you. So Ryan, talk to us about handling rent defaults on your assets.
Yeah, I'm going to get to rent defaults and mortgage payments in 1 second. I want to just comment on 2 things that are pretty important. The first one is, as far as questions go in this community, and as far as questions go at Atlas, there's never a bad question. We really exercise vulnerability. We really exercise courage in our company. We also exercise the ethos of failure is okay, and let's learn from failure. Of course, there's different levels of failure, and we're talking about some big levels here, so let's understand that. But please, any question is great. We're an open, broad community. And the other thing that Tony said a second ago about Fannie Mae and Freddie Mac and them looking to do some forbearance on mortgage payments. Just to clarify, so far it looks as though the communication on that is around multifamily properties, not residential properties. So Fannie Mae and Freddie Mac have a multifamily category, which is a commercial lending category, and they also have a residential category, which is to our homes. And so more news to come on that, but the government, the GSEs are working on that, as are banks. So I'll loop back around to it. So the question was, what do we do about rent defaults on our assets? I'm gonna speak for a moment about what I'm going to be doing on this, and I'll cut it up in a couple different ways. And this might just be a little bit of exercise and vulnerability on it. I own a lot of commercial real estate. I own a lot of restaurants, gyms, wellness, that category. And in the last few days, I probably had 10 or 11 tenants that probably pay, 5 to 6 figures in monthly rent that have all said they can't make rent payments in April. So the pain on this is very real on all category. I'm incredibly grateful that I get to be in an opportunity where I can say, okay, this is pain, and I can accept the pain, and I can lean into it. It's okay, and I want to be a partner for those tenants out there that are going through way more pain right now, I'm sure, for their businesses that are on the line. And I'm taking that role with a compassionate heart, and I'm going to come up with a plan for those folks on the commercial side. And I think that mirrors on the residential side. And I'm just starting to get some emails from our residential tenants saying, hey, we're not gonna be able to make April payments, or what does it look like if we do a plan? The first thing that I'd say is you gotta work with them. You have to work with them. So much of real estate and so much of the market is about who has the power in that moment, okay? And one of the things we talk about at Atlas is just because we've had the power as the landlord, as the property manager for the last several years, because of supply and demand, because there's been no supply of affordable or any housing, and there's been tons of demand. Well, of course, the people that have the housing is going to have more leverage in that conversation. We don't want to take advantage of that. We're still treating with people with dignity and respect over the last many years. Well, your resident that comes to you and says, I don't have the money for the rent, they're going to be in an environment in the next 30 days where there's going to be a ton of real estate that is available for rent. And if you don't work with them and you don't figure out ways to be their partner and work on payment plans or rent abatements or deferred or take it out of security deposit, I mean, there's a whole host of different ways to tackle this. If you don't work with them, then as soon as they are able, they're going to tell you to go fly a kite and they're going to go next door to the property that's vacant and 20% cheaper or 50% cheaper, or who knows what. The guy next door that's sitting there saying, I don't even care if you sign a 1-year lease. I'll do month to month with you. Just occupy my dang building. And I can't describe enough how much I lived through that, particularly in 2009 when we had transitioned to a real buy and hold portfolio, and the market dynamic continued to get worse on a rental level. And we had signed 1-year leases with folks at $1,200, and they would come to us a month later and they say, hey, dude, the house next door is at $950. And I mean, they're like, hey, you can come collect off of me. I've got every creditor on the planet already collecting on me. I don't care if you try to collect on 11 months of rent. I'm going next door. And so what did we do? We went down to $950 and kept them in the house. So we let a lot of income go according to my pro forma, but I stayed in the game. And I was able to keep my asset, I was able to pay my bills, and I was able to still be a positive influence on our community, which is part of the rebuilding process of making sure that we have a healthy real estate market. And my alternative was that I let them go, I begged for another tenant, I had vacancy for probably 2 or 3 months, and I'm still gonna be at $950, if not worse, because the market could cut against me worse. And or I'm left with trying to sell my property when, if you're a buyer right now of real estate, are you really actively going out there trying to buy like crazy? No, you're saying, oh, I'm gonna hold on. I'm just gonna see how this thing settles out. It doesn't mean that you don't wanna buy real estate, but you're gonna hit the pause button for 30 days. Well, that means I'm not gonna sell my property right away. It means that the days on market might go from 23 days on market to 53 days on market. So as it relates to rent defaults on assets and how to deal with rent, we're training our property managers on this, and they're already very aware of it. We're going to recommend that you work with the tenant. Ideally, you understand what you must get out of that home to pay your bills. That's a really critical data point that we need to know. We also need to know what you need to get out of the home to stay alive, because every single person's circumstance is a little bit different in understanding, okay, I can afford to not get $1,000 a month for my rental portfolio right now because I've got cash reserves and it'll keep me in the game. That's the more healthy long-term position perhaps. And sometimes you can't make the long-term decision. You got to just focus on the now and hope the long-term cuts in your favor. So we're going to be your partner in that, just as we would ask that you all are partners with your renters. So that's rent defaults on assets. We also are going to provide all of our residents and you with all the resources that exist as far as what Section 8 can be captured, and other county and government assistance and nonprofit assistance that's out there for rent assistance. We do these things all the time. And in addition to that, there's all sorts of new ones that have popped up as a result of this with the stimulus package, with what the city of Denver is doing, the state of Colorado, the city of Phoenix, Maricopa County. All of them are coming together, and those are going to be other resources we can pull off of to keep the lubricant in the machine and hopefully keep our economic engine moving. So that's the broad commentary on it. Go ahead and throw follow-up questions on that in the question queue. I'm going to move on to the next one, which is mortgage payments, unless Tony interrupts me.
A lot going on around the mortgage stuff, a lot of those questions, but Ryan, I'd like you to talk a little bit about, is now a good time to sell a rental property in order to buy a more profitable property?
Two things on that. We scheduled the webinar for 30 minutes. We're going to go as long as we need to, so I'm not worried about that. Hopefully everybody is appreciative of that. Second thing on that, looking to sell a property and buy another one that is more profitable. It's a great question. Right up until when this epidemic settled in, I was looking at selling many assets that I thought were highly valued that I could then trade into better investment properties. This is part of our portfolio evaluation or lazy equity review process that we do with our clients that have bigger portfolios of real estate. And I was just doing it internally as an annual exercise. And I was probably going to sell anywhere between 5 and 20 assets. Each of those assets might be 1 door or 50 doors or whatever. I've since decided to pull the plug on the sale of every one of those. And the reason why I have is because I said to myself, in order to sell a property, let's say it's a home, I have to vacate the tenant, I have to do fix up, and then I have to put it up on the market for the price that I think I'm going to get, which is a rear view mirror price. Then when I don't get that price, I got to drop it, drop it, drop it. All that time I'm losing occupancy and rent through my vacant months. And then I get settled and done and I say, I'm not going to get the price I want. Well, what could I rent it for? What I could rent it for is a fraction of what I had it rented for before. So there's just too much uncertainty on that right now that I couldn't recommend doing that at this point. And so I would not say that I would sell out of an income producing strong investment asset to try and capture a better one. Now, right now, there aren't better ones out there. Nobody said, hey, this is terrible. I'm going to drop my price on the real estate asset purchase by 20% so that it looks like a great investment. They're saying, okay, let's just see what happens. Let's leave our pricing where it is, or we'll just drop a little bit. We don't know if there's going to be a sale in real estate, a discount on real estate prices as a result of this. And we won't know that for several months. So patience is the key on that.
Ryan, can you talk about, as an owner of real estate, how we should be thinking about reserves?
I'm usually answering this the way I'm thinking about it, and then I'll add context. So the way I'm thinking about it is I have reserves. I have plenty of reserves. I'm finding more reserves. I'm getting any kind of new reserves I can. Cash is everything. We have no idea if this is a problem that's going to last 1 month or 1 year or longer. And we don't know the ripple effects of this. I don't think that we've seen something quite like this, unless you want to date back to the Spanish flu, which was 100 years ago, and that's not modern history. And so reserves are everything. And I'm drawing on reserves in every way that I can. I'm saying, okay, what do I have in cash in the bank? That's great reserves. I'm understanding what other liquid assets are at my disposal that can be used as reserves. Now, some of those liquid assets I'm not going to want to liquidate, but stocks and bonds, I may not want to liquidate, particularly in the environment right now, because they're down a third in the last couple of weeks. But I need to know that they're there, and I need to have some thought process around why I might trigger in selling some of those. Those aren't 401ks and IRAs. Those are liquid stocks and bonds. I'm also looking at other, money markets and CDs and savings accounts. All those as part of my reserves. But then in addition to that, I'm also looking at creative ways that I can have access to capital. And a lot of that comes down to a financing mechanism. So do I have lines of credit on my real estate or on other hard assets that if I need to, I can draw on for specific real purposes to keep the engine moving forward? Now, if I'm going to draw on those lines of credit, I really have to think about it. I really have to understand why I'm doing it. And the reason for that is if I'm drawing on that line of credit just to feed a money pit that's never going to repair itself, and I'm going to be upside down on that money pit and it's never going to change, then never draw on your line of credit, because you're just putting good money after bad. And that's a huge problem. However, if you're drawing on that line of credit so that you can continue to be in the game in the short term to still realize the benefit in the long term, then that can be a great tool in terms of other liquidity, other cash reserves. I'm even looking at cash out refinances in some cases, not because I want to increase my costs. A cash out refinance is going to increase my debt load and therefore increase my monthly costs as well, but because I might be willing to say there's a value to having that amount of capital in reserves on the sideline so that I can still manage all of my real estate portfolio. So those are really difficult decisions, and there's a lot of thought process in them. And whether it be your property manager or it be your investment specialists on our investment brokerage team or one of our other real estate professionals, all of them can be good thought leaders in thinking through the correct response on that. And they really come down to your individual circumstance and your goals. And there's a global picture there that would be difficult for me to comment on for any one individual. But reserves, have as many as you can. I love the idea of being able to have reserves for your living expenses of 6 to 12 months in the bank. The tricky part on that is that your reserves for living expenses over a 6 to 12 month period today might be this much. But if you have a real estate portfolio that usually put income into that and paid for expenses, and then all of a sudden all of your rents start to dissipate or get cut in half, well, then you're going to need even more reserves because your expenses effectively go up personally. And that's where it's tricky, that you need to stress your portfolio a little bit. If I was making $10,000 a month in my real estate portfolio, what does it look like with $8,000? And how much does that cut into my global income picture, as well as how much reserves I should have.
Ryan, can you talk a little bit about, there's a series of questions here. First, do you agree that security deposits should be applied from tenants towards payment of rent as part of any concession?
That is a strategy that I wouldn't say is one that would be my first line of defense. A security deposit does more than just capture unpaid rent. A security deposit is part of our implicit pact or agreement among the property owner and the renter. And the agreement is, hey, renter, I'm going to provide you with a great home. I'm going to take care of your maintenance needs. I'm not going to meddle in your affairs. And the renter says, great, I'm going to pay my rent. I'm going to pay on time, and I'm going to take care of your property. That's the security deposit part. And if you tell the renter, hey, look, your security deposit is just going to go towards past due rent, you lose a level of accountability associated with that implicit contract. You lose that level of, hey, I'm going to take care of your property, at least psychologically to some level. And so I think it's a great tool for us, but I'm not going to say that's my first line of defense, because I like the idea of having the security deposit at the end of the story still as a way that I can pull on from unpaid rents. But I don't want to necessarily communicate to the renter, hey, look, we'll just take this from security deposit, we're done. I'm going to communicate to them, hey, we're going to figure out a payment plan on this, or I'm going on a one-time basis going to reduce your rent by X amount. And if you re-sign your lease in 6 months when it's up, it's going to be completely forgiven. But we got to re-sign. We're good there. Okay. Or hey, I'm going to reduce this right now, and and the property manager knows that it still is rent that's owed in a payment plan. And if at the end of their lease they still haven't paid off that temporarily forgiven rent, then you have the security deposit to pull from to pay for that unpaid rent.
Ryan, for commercial leases backed by personal guarantees, what sort of diligence do you plan to conduct on the personal guarantees before considering giving concessions?
Great question. Commercial property. The question means that the tenant has personally guaranteed the lease, meaning that they did a 5-year lease. They might be on year 2, and they're saying, hey, look, I can't pay for next month's rent. And you're sitting there saying, well, too bad, I've got your personal guarantee. So I'll come after you personally if you don't pay your rent and you don't fulfill your lease. For me, I'm going to ask my commercial tenants right now to be transparent with me as to their financial situation. In my commercial leases, it states that I can have their P&L, their financials, their balance sheet, their bank statements, their operating agreements, all that good stuff. So I'm going to request that information because this is a moment where it's good to get synced up on it. And I want to have that information. That will inform me what they look like personally. And I'm probably not going to rely on that personal guarantee very much. I'm not going to tell them that I'm not going to rely on it, but I'm not going to rely on it very much because I know how difficult it is to squeeze water from a rock. And in most cases, particularly with a non-institutional class commercial tenant, the personal guarantee is only as good as their couple real estate assets, or their one real estate asset and a little cash in the bank. And in most cases for a tenant like that, they're going to wear through all their reserves and their cash in the bank trying to keep their business alive because it is their business that they've been bleeding for all these years. They're entrepreneurs. I know what that feels like. They're going to use their liquid reserves and they're not going to be available to me when we're done. Then they're going to have their house and they probably don't have that many other tangible assets. So am I going to go foreclose on their house based on the personal guarantee? That's pretty tough. And even if I did that, I've got to contend with the Homestead Act and the carve out of the equity that's left for them no matter what happens because of the Homestead Act. And then I have to ask myself, they probably put 5 to 20% or 30% down on their house. What if real estate prices compress to the level that it makes no sense for me to try and capture the 5% of equity that's left because I know the true cost of foreclosure? So I've been through that iteration before. I've had to foreclose on notes that I bought from banks before. I know what it looks like to do that. I've had to deal with trying to collect from personal guarantees. I think that is a tool that in the vast majority of small commercial real estate cases is not going to be that helpful, and much more helpful is working with that resident. And frankly, it's the same on the residential. On the residential side, technically, in many cases, we have them covered personally in a lot of ways in terms of not paying for the rent, and we can try to collect from them from the credit bureau or a collection company, but we're going to have a real hard time collecting that money. We need to work with them.
That's good. Thank you. So lots of great questions here. Ryan, if this epidemic were to end in a month or maybe two, let's say, can the market get back to the state it was in back in January?
Well, I have no crystal ball, but I think if the epidemic ended in a month or two, and if federal and local governments provide some sort of stopgap, and frankly, if we're patient, if we have a patient attitude, then we're going to snap back quickly. That would be my opinion. That fundamentally supply and demand is still there. The businesses that have been shuttered as a result of this are going to reopen. A lot of them won't be able to reopen, but they'll get there, and that demand will recover quickly. There's some interesting data that I've read over the last week or so that demonstrated what happened with real estate prices during the SARS issue, which was about 20 years ago, as well as some of the H1N1, bird flu, swine flu, that kind of stuff. And those were very brief. You saw activity. It was like this, it plummeted, and then when it was fixed, it went right back up in terms of activity. That wasn't pricing, that was activity. And so I think there's hope that if this can be short-lived, it'll be a strong response. I'm feeling a little bit more dismal that it's going to be short-lived because of the ripple effect of what's already happened. It's not just the restaurants and hospitality. I mean, the airlines are getting devastated, and I think it's just done. Everybody sees it in the news. There's no sense in going into it. When the stock market gets pummeled by 33%, a lot of that is human reaction to a problem. There's not really data that says it should be down 30% in a couple weeks. But what is real is that earnings from companies are going to be wrecked over the next quarter as a result of this. And the stock market should trade based on earnings, a multiple of earnings. There isn't going to be any earnings. That's a real economic indicator. Earnings are going to be destroyed. So that part is real, and that's going to have a ripple effect on real estate and what happens here. We'll just see if it's short or long. I'm preparing as though it's long, because if I prepare for the long and it ends up being short, I'm in a beautiful position. If I prepare for short and it ends up being long, I'm out the game. And so this is all about making good long-term decisions and frankly having short-term pain, which I'm okay with. And I think Atlas is, and we try to manage the company to that end.
Ryan, will you be approaching relief for current tenants the same for everyone, or offering different options?
That's not a question that is going to be, I can't say that it'll be the same for everyone. Every owner needs to ask that question a little bit differently. Every tenant is going to be in a unique circumstance. We're always going to comply and abide by fair housing, and that's not even really what the question is about. But there's so much intricacy and detail in terms of what has gone on with that tenant relationship in the past, what it looks like in the future, what has gone on with the owner, and what their goals are and their needs are. And so those will be case by case. However, we're going to provide guidance, I think, as a starting point. And I think that guidance is similar to what I've said, which is we're going to come at this with an attitude of working together. We're going to keep our possibilities open in the short term. We're probably going to try and make plans where it's a rent deferral as opposed to a rent forgiveness to begin with. It's, hey, can we defer rent in part for 1 month, in full for 1 month, and then turn it into a payment plan? And that's a conversation with the owners. I think that for a lot of my specific residents, I sort of look at some of this guys as, and this is again very individual. Every year I make charitable contributions. Maybe this year my charitable contribution is I'm going to try and keep some people in the game. I'm going to try and keep some of these commercial tenants that have been partners of mine, frankly, for 5 and 10 years. I want to keep their businesses going. And that's part of just the way I'm thinking about it, that it's okay if I put a little bit of money to that and I don't see a return on investment on that. Now, this is a personal philosophy. Frankly, I think that personal philosophy makes immense economic sense, because at the end of the day, when I come back and do a renewal with that tenant, whether it be commercial or residential, they're going to remember that, and they're going to feel like I'm their partner, and they're going to say, you know what, it's not worth it to move somewhere else. These guys are good. That's why at Atlas, our average occupancy is over 3 years on our residential product. I think on our single family residential product, it's like 5 years. We treat people with dignity and respect, and we understand these things, and it actually pays way more economically in the long run. But you have to have a long run perspective.
Ryan, where do you see the biggest opportunities for real estate investment presenting themselves in the next 6 months, both property types and locations?
Well, the first thing I'll say on that is that I do know there'll be opportunity in commercial real estate, but I always caution people that don't already have experience in investment from diving right into commercial real estate. We're seeing the best example of it right now. Commercial real estate can be great, but when there's problems, the problems are magnified and much bigger. And oftentimes people will jump into commercial real estate and they don't realize that every time a commercial asset goes vacant, it's not 1 month vacant, it's 6, 12 months vacant. And in most cases for my commercial assets, when they go vacant, I'm also doing a tenant improvement package. And that might be a $50,000 or $100,000 tenant improvement package. Commercial real estate requires a lot of money to successfully manage to the long term and be in the game through the ups and downs. So I think there'll be opportunity there. And we can say there's going to be opportunity in retail and restaurants and other areas of hospitality and gyms, because we're going to see some fallout in those categories. But I don't know what the fallout's going to look like yet. And I give words of caution on that for folks that don't have the balance sheet to withstand some of those ups and downs. I think that as it relates to residential real estate, both single family and multifamily, it really depends on how long this thing lasts. If this thing is a 2-month issue, I don't think there'll be a lot of opportunity. And if it ends up being a 6-month or 12-month issue, it's also going to really depend on what happens with the foreclosure markets. Because we may find that the government says we're going to put a moratorium on foreclosures, and instead of it being a 4-month process, it's going to be a 12-month process. Well, this could correct itself in that amount of time. So, and then you also have the issue of shadow inventory, which we saw from 2008 to 2012. That's the inventory that actually is vacant and on the books of somebody, usually a bank, that they aren't releasing to be sold. And so there's all sorts of market mechanisms that play into it. I think it's much too early to say where the next opportunity is. I can say that I think there will be opportunity as a result of this, but I'm not certain it's even in real estate. It might be that the opportunity is in new businesses that are available, or buying businesses that used to have a great operation and now they can't make it through this transition, or other categories altogether. It may be, sanitizing wipes as you see out there or something. But I'm not sure it's in real estate. Most of this call is focused on what do we do based on the real estate portfolio we have now. If I were looking to buy investment properties right now, I'm not saying that I would stop doing that. I'm just saying that I'm going to be patient. If I have a property under contract right now, I'm gonna call up that seller and I'm gonna tell them, you know what, we're waiting 30 days. Okay, it behooves you to wait 30 days, and I'm gonna create a story around that is very solid and that holds water. And it behooves me as the purchaser to wait 30 days. That 30 days is gold for me, because we don't know if the value of the property that I was about to buy at $1 million is going to be worth 900, or it keeps on soaring up and it's 1.1. So there's no harm in waiting that 30 days. And even if my earnest money is hard, I'm still coming at them with that. And if I have to lose a little earnest money on this, on $1 million property, let's say I have $10,000 in earnest money, I'm probably willing to lose the $10,000 in earnest money if it's hard earnest money, as opposed to being forced to purchase $1 million property right now, because 30 days from now, that $1 million property could be $900,000. We just don't know. And I'd rather lose $10,000 now than $100,000 in 30 days. So I'm preaching patience, because there is a huge, huge likelihood that we're going to come roaring out of the gates on this, and buyer demand is going to be through the roof. And frankly, I still see it on the streets in terms of buyer demand to purchasing homes, and inclusive of investment real estate. The market indicators would say that Denver still has a massive amount of demand on that. And I'm simply saying patience is valuable right now.
It's good. Thank you. I'm in the middle of a 1031 right now, Ryan. Might it make sense to just pay the taxes and the remaining cash to deploy later?
Well, you probably, I don't know where you are in your 1031. If you're in your 45-day identification period, identify as many assets as you can based on your requirements. Many people think it's only 3, but it doesn't have to be only 3. It can also be twice the value in 10 different assets. So get with your 1031 company to make sure you identify as many properties as possible. I would still identify those properties. There's no harm in that. And then thereafter, I would try to put those properties under contract. And for me, I would put them under contract as though I was going to close on them in 30 days, 60 days, 90 days, knowing that if the market cuts against the price. So I put a property under contract. I put it under contract at my same deal of $1 million. And 60 days from now, when I'm supposed to close on it, it's evident that the property isn't worth $1 million anymore. It's only worth 900,000. Well, who's in control here? Even though I have a contract to buy it for $1 million, I'm going to go back to that seller and I'm going to say, wait a second, the value is 900,000 now. And if you want to sell your property, there's no chance you're getting more than 900,000. Here's the data. I'll still close on your property for 900,000. So I can still do that and execute on my 1031 in very high likelihood. And if it doesn't work out in my favor, then I'm prepared for that. Maybe my 1031 exchange doesn't work out and I have to pay taxes on it. And paying taxes, guys, nobody likes doing it, but it means you won. You're just paying taxes on something that right now means that you have cash on hand that you can sit on and go buy a great asset with if the market does go down. So there's value in having cash right now. So I don't think that's the end of the world. I don't think that I would plan on exiting the 1031 as my first line of defense. I would plan on trying to lock up the deals that I think are feasible, knowing that I may have to negotiate down the price or retrade on the price to still make the deal work if the market cuts against me to some degree. That's a benefit to me, and I still don't pay taxes, and I've got to win. And then I figure out what my next best alternative is, my next best. I would say probably exiting the 1031 exchange might be the third best alternative, but that's going to be case by case.
Ryan, can you expand on any other forward-looking metrics that you're paying attention to when evaluating markets, aside from new listing versus sold?
Forward-looking metrics, yes, I'll expand on that. I got one other thing here that I probably should have said earlier on. I hope that the participants listening to this call feel as though, here we are 51 minutes in, that my commentary here has no ulterior motive, has no other agenda. This is purely what I'm doing to manage this crisis, and it's as honest opinion as I can give. And so I hope that's felt. If you're uncertain of that, challenge me on it, challenge Atlas on it. But we are always going to do our best to be authentic and honest and give bad news faster and first and make tough decisions faster and first. So there's no service in saying, hey, look, this is, do this because it benefits us or not. This is what I would do if I were in the situation. So that's my disclaimer. So the question was on what other forward-looking metrics am I looking at? I'm absolutely looking at unemployment claims. I saw them day over day until the Colorado State unemployment website crashed. What was that, 5 days ago or something? It peaked at 6,800 in the day. That's a real big one for me. I'm absolutely looking at businesses and their layoffs and which businesses are overtly claiming that they're being affected and which coalition groups are saying, hey, look, this is what we're doing to protect against this. As it relates to real estate specifically, it's number of listings, the number of sales, changes in purchase price, original list price to closed list price. So if I listed at $1 million and I closed it at 990,000, that's 99% is that number. The closing close price is 99% of the original. Well, if that moves from $1 million to 91%, that means that property sold for 910,000. That's a really good indicator. I'm looking at days on market. I'm also looking at the debt markets. And the debt markets right now are interesting because interest rates are slashed to zero from the Federal Reserve standpoint, but mortgages have stayed relatively high. And that's a commentary on risk and reward for the mortgage markets. I anticipate that the mortgage markets will come down as more certainty is described in the marketplace, as the stimulus plan is approved, and as we have a little more time under our belt, which is a whole nother commentary on what to do about your financing. And we still haven't talked about mortgage payments, but I think there's financing strategies. So.
It's great. How would you characterize buyer activity for single family residences over the past 2 weeks?
Strong.
And what effect, if any, do you think low rates are having on sustaining interest in home purchases for owner occupants?
I think that the last 2 weeks buyer activity has been strong. I've been really pleased with it. I think it's going to continue to be strong, particularly in the less than $700,000 price point for Denver. For Phoenix, it's probably more like a less than $500,000 price point. In Colorado Springs is probably less than 450. Fort Collins is probably less than about 500, 550. So that sort of first, second time home buyer category has been strong over the last 2 weeks. I actually think that mortgages will be an assistance to this in the coming 2 to 4 weeks, because mortgage prices should come down as markets settle out a little bit, and that will assist in encouraging buyers to come to the table. So I think that category is strong. And the converse of it is, are sellers still going to look to sell their home in this environment? A lot of people are uncertain, so they're pausing on it. Are we able to get buyers to view homes? That's a big thing. Shelter in place was announced in Denver, effective 5 p.m. today. Thankfully, real estate was considered an exempted category of the shelter in place order from Mayor Hancock. Hasn't been enacted in Colorado Springs, the rest of Denver Metro, Fort Collins, Phoenix. If those are, actually, I don't know in Phoenix. I believe it hasn't yet. I'm almost certain. If those are enacted in the other municipalities, inclusive of Denver, and if it impacts real estate, then buyers aren't going to be able to go look at buying a home. And as much as virtual tours and everything else are helpful in that, if you're a home buyer, you want to see the dang home. You want to see what the neighbors look like. You want to see how close that power line actually is to the back of the house. So there's components that you just need to see. And if that happens, there'll be a screeching halt, in my opinion, to home buyer activity for the short term until they're lifted.
That's great. Guys, we'll do a few more questions here and try to wrap up at the top of the hour. Ryan, are we going back to auctions?
Way too early to tell. My inclination right now is no. And you know what? I don't even need to waste time thinking about that. That's far enough in the future that it's going to be obvious if that's where we are. If I'm thinking about that, I don't understand what I should be working on. What I should be working on right now is making sure that my investment portfolio is shored up, that it's going to be safe and secure, that I have great relationships with my residents, that I have great relationships with my property management and my construction vendors, with my bank. Great relationships with the bank is a big deal. I'm not even thinking about, hey, there's going to be auction opportunities right now. I'll have plenty of time to think about that.
Real estate tends to lag public equity markets. So that being said, do you think that'll be the case in this particular downturn when you look at public equity markets? And do you think that'll be indicative of an optimal time to buy real estate?
Real estate does not always lag public equity markets. Real estate is not always correlated to public equity markets, is the first thing that I'd say. We've seen correlation in the past. It will continue to be correlated in this issue if this issue settles in for several months. Real estate's going to take a few months to settle in and do that, versus the public equity markets can respond in a day or an hour. So it's too early to tell on it.
For homes under contract where Atlas is the listing agent, what kind of growth and cancellation are you seeing or expecting to see?
So far, we haven't seen a lot of cancellation on that. I think it's been pretty minimal. We've also coached our sellers to be patient and maybe, push it out 30 days. And I think that right now, I don't anticipate seeing a lot of those canceling. I think that if you're looking to sell a home, you're still sitting there saying, yeah, geez, the market has been at $500,000 for a home, and very well, the demand could all still be there. So I'm going to put it out there at $500,000 and see what happens. We've seen good activity. We've seen multiple offers on a lot of properties in the last week, and there's activity out there. There's good data that a seller should still be selling their home.
Can you talk at all about traffic for open or vacant rentals the past 2 or 3 weeks?
Traffic is down. I can't tell you yet to what degree, because the commentary I'm getting is anecdotal. It's, my property manager saying, hey, yeah, we're down on traffic. It's light. So it is down, but I don't know to what degree. It's a little concerning that it's down because of spring season, and this is the beginning of an aggressive season. I don't really need to know that it's down because I already know what's going to happen here on this. We're going to have way less rental demand. Your renter is the most impacted by what's going on right now, and your renter has the least personal reserves available through which to withstand any economic hiccup. And so renters are going to say, I'm not going to go rent a property. I'm going to go move in with my friend. I'm going to go move in with my parents. I'm going to move back home in another state. I'm feeling very confident about that, which is the first 30 minutes of the phone call that we went over.
That's great. So we've got 1 more minute here.
Hey, Tony.
Yep.
I think that we're missing if we don't discuss mortgage payments a little bit.
Okay. And you can take that. I've done a lot of reading on that today too, so happy to help there.
I'll just take it broadly because we'll have specific guidance. What I would say in your mortgage payments is that your bank wants to work with you. Do not hide from the bank that you are having trouble making your payment. Make it known to them and make them your partner. They do not want to take your property back. They want to see you paying on your property. Therefore, all the tools are at your disposal. Interest-only payments on the mortgage that you owe. I called up First Bank, and I have a ton of loans with First Bank, and I said, hey, look, I'm in a great cash position. Is that something that would be available to me interest-only so I can shore up my cash position even further? He's like, yeah, I bet we can do that for you. And then he offered up without me even asking, hey, if you want to just skip a payment too, I have carte blanche approval on that. You can just skip payment right now. I don't need to skip a payment. But he's saying, yeah, just go for it. Skip a payment. We'll do the doc. No harm, no foul. You know, it probably adds the payment to the end of the mortgage, but from a cash flow perspective, it's a big deal. I'm even asking myself, geez, if I were to be in a very cash strapped position, I'm sitting there saying, what is the likelihood right now that if I don't pay my mortgage, what is the consequence? Usually in a normal environment, if you don't pay your mortgage, the consequence is foreclosure. The consequence right now is going to be completely different. So having that thought exercise helps to equip you on what the right decision is. I'm not saying you don't pay your mortgage payment. I'm saying go through the thought exercise of what happens so that you can make great decisions from that perspective. And then probably call your lender and say, hey, look, this is the reality. And make them your partner. And we're going to see all sorts of plans around that. I think we'll also see plans around not evicting people that can't pay their mortgage. But then also tied to that is that the mortgage company probably will not be able to foreclose on you if you can prove that you didn't evict somebody that wasn't able to pay. So there's a whole correlation here. And what the federal government is trying to say is we're keeping the wheels on the bus in these different ways to keep the system moving because we think when this thing ends, the system was already moving great and it'll pick right up. That's kind of the way I'm thinking about this.
That's great. We've gotten to almost all of our questions here. And one of the questions that I've seen a lot is, will you do more of these? So for everyone that has hung out on the line with us, yes, we will be doing more webinars. And please watch for those. And we'll just evaluate as needed and on a regular basis, making sure we're giving you updates. Ryan, one of the questions that came up several times that I think we should end on is what is your favorite color of underwear?
I don't care what color underwear. Underwear means to me. It's a good question. Thank you, Seth Johnson. I'm sure that was you.
Yeah, of course.
Favorite color of underwear probably needs to be pink. Yep, that's my favorite right now.
Pink.
I don't even own pink underwear, but if I had to, that's what I would go for.
I could have guessed. Thanks everyone for attending today. Other questions that have come up a lot is, will there be a recording? Yes, there will be a recording and we will share that. Several of the questions in the Q&A I was able to answer just by typing an answer, and we'll make those available as well. Thank you to Ryan for committing the time to this and the insight. Thank you to everyone that was able to attend, and we hope that you'll attend again in the future.
I have one more comment for anybody listening. It's our personal responsibility right now to be a positive, smile, light to anybody that we touch and talk to. Everybody's down. If we have the opportunity, bring a smile.
Amen. Thanks everybody for joining. Have a great rest of the day.